Good morning, and thank you very much, Marty, for having me, for the sponsors, and the beautiful dinner we had last night. Appreciate it very much. Like Marty said, we've known each other for quite a long time, and it's been a pleasure, and it is a pleasure to be back. Marty asked me to speak on the economy, the global economy, and so some of my comments will be domestic. We'll try and focus on, or at least hit on the macro global economy. As the agenda indicates, who are you getting that up right now for us?
Yes.
Yes. We'll look at the global economy. And one of the things I like to look at is the components to growth, right? So we can kind of forecast what's going to happen as a result of the components to growth. Monetary policy and then inflation, right? So the two of them go hand in hand. The thing that keeps me up at night is the debt and the deficit. So we'll have a little bit of commentary there. But the global economy continues to recover, albeit quite slowly, from the blows of the pandemic crisis. And we really have had a kind of a cost of living crisis. But still, our resilience has been pretty spectacular in the United States. So we've had unprecedented tightening of monetary conditions around the globe to combat the decade-high inflation of the global economy, and it has stalled, it has slowed, but it hasn't stalled, right? So growth and expected growth going forward is expected to remain slow and uneven, but what's interesting are the global divergences with respect to interest rates, exchange rates, and growth. So while we're not sprinting, we're limping along. It's probably bottomed out, and inflation is gradually being brought under control. I think while the components to global growth are shifting away from the developed markets to emerging markets, it's happening in part because of the demographics of the emerging and developing economies, right? You've got to have people to contribute to growth, right? So as they incorporate new technologies, AI included, and continue to grow their workforce, the composition of developed to international, developed to underdeveloped or emerging is shifting.
Okay, am I on the right slide?
Next slide. Thank you. This slide is kind of separated, obviously, on the left side. No economist can give, should, maybe, in my opinion, given a description of the economy without maybe slightly describing at least what the economic growth means. What is GDP, right? So it's C plus I plus G. So consumption, consumer spending on the left-hand side of the screen here, business and capital investment, government spending, and imports and exports, or net exports, right? So what do we project for growth? Well, we expect that growth will slow, global growth will slow to just under 3% this year, well below historical averages, right? But this is consistent with the soft landing. It's kind of a miraculous soft landing so far. One of the economists yesterday apparently doesn't think there's, that the banking system is resilient and it's not going to collapse like it did in 2008. And as a matter of fact, just a year ago too, that we have some legs under us there. And it seems so far to be a soft landing, bringing inflation down with any major downturns in activity, especially in the United States. And with this soft landing, we do kind of expect U.S. unemployment by design to creep upward closer to 4% by 2025 in order to achieve this soft landing. But as I said, divergences are occurring and appearing globally. The slowdown is definitely more pronounced in more of the advanced economies like Europe and the United States than they are in the emerging markets, except for China, right? So many emerging economies have proven to be quite resilient and have surprised on the upside, India, for example. But China, as we know, facing the headwinds of the global, their real estate crisis. But as I said, the global economy is undergoing a shift in gravity from the West to the emerging markets. nearly a decade ago, the G7 companies, and this countries, excuse me, and this was something Marty and I were just talking about, the G7 economies collectively had about 2.5 times that of the BRIC economies. And now it's closer to 1.5 times. So this is kind of the shift that I'm talking about from developed to emerging.
Is this the right slide?
No, back up.
Back, okay.
Mm-hmm. That's a fun slide, though. We'll get there. So right now I'm kind of right, and I guess I'm talking about this. You know, the slides aren't perfectly aligned with my lecture, but let's talk about those global forces at play for global growth, right?
Before you go on, can I ask you,
yeah.
Is that 2.5 to 1.5? Is that because of shrinkage on the industrialized?
It is because of shrinkage on
or because of growth on the global south?
Both sides.
Okay.
Both sides working at the same time. Increasing in demographics and use of technology on the emerging side, shrinkage in labor force, and growth on the developed side. Good question. Thanks. Like, for example, okay, so what we are seeing, one of the interesting things to me, at least back in March 2020, right after the pandemic kind of hit, was this idea that, okay, what's going to happen, right? The economy is going to be affected. And I would have telephone calls with people and they say, well, okay, 6 months out, we'll be fine. 12 months out, we'll be fine. And I kept saying, well, you know what? I think it's going to be 10 years. I was an outlier, right? So we're 4+ or so into it. Is it 4? 4 years into it. And what we are finally seeing is the service sector that was initially hit is the one that's recovering. So over the past year, there has been strong demand for services, and so those countries like France and Spain have recovered more than, for example, Germany and China, that are more industrial economies, right? So we see that service activity is still weak, but has gotten stronger. Services, then we should start to see the prices of services like airline. We already see those prices falling, and we may actually see some softening there, but we have seen some recovery. And then this idea that we've tight money all across the globe, right? It's necessary to bring inflation down, but it started really to transmit through the economy, through our domestic economy, but transmitting unevenly through countries. So tight credit conditions are weighing on our housing market, our investments, and importantly, those people with adjustable rate mortgages are being hit really hard, right? We have seen increases in US and Euro, especially European bankruptcies. So while starting at historical levels, we've seen that increase. That is to be expected, right? We're engineering this slowdown, so this is not unexpected. And then obviously inflation has been kind of shaped by the war in Ukraine and the idea that we've had some global energy shocks that would not have been there otherwise. So obviously Europe and others more dependent on that energy supply have been more hurt. Now, just to move to the other side of the first slide, right, drivers of growth. What drives growth? And growth is real domestic output, not nominal. All of the slides that you'll see from me today are real output, so removing the impact of inflation. So what drives growth is real output per worker or productivity and the number of workers, right? And so this is another reason why the emerging and developing economies are expected to grow relative to aggregate global GDP. But employers are not only battling inflation and slowing growth, but worker productivity that is falling at its fastest rate in 4 decades. I mean, output per unit of input, right? The skyrocketing cost of living is also taking its toll on workers. Research shows that over 50% of American workers are more stressed about their finances now than they were a year ago. No surprise. I was kind of curious about this. Oh, we were hitting last year GDP numbers, nominal GDP numbers, 4-5%, right? And consumer confidence very, very low? Well, it's the impact that higher interest rates are having on the pocketbook and higher prices are having. So we've had consumer confidence extremely low while the economy is humming along, and that's an unusual pairing, right? And we talk a little bit, or some of us a little bit about engagement, like how do we get productivity up? How do we get worker productivity up sustainably? And we talk about engagement, right? It's not happiness, but engagement is tied to, it's tied to happiness, but it's not happiness. And so engagement, though, it is tied to improved outcomes like productivity and profitability. There's a strong link there. So I wonder how we're going to, some of us, produce highly engaged employees. I personally think that getting back to the office a little bit more might be one of those things that we could do to improve engagement. And so we've got risks. Unlike my cohort yesterday, I do think there is some risk in the banking sector, banking instabilities. Let's just say there is some downside that we might want to consider. And then the real estate crisis in China, if it deepens further, will have an important impact and slowing impact on the global economy. Because if those real estate prices decline too rapidly, obviously the balance sheets of the banks and the households are going to get bad. And don't forget the financial contagion that we all knew about in the 90s, right? Financial contagion is a real risk. So if China's property market falls and their bank balance sheets become weak, it could easily have some impact on domestic and European banking. Obviously, we've got commodity prices as a risk to the forecast, right? As a risk to the 3% global forecast. We're not in a recession, but that's a very slow growth rate for the global economy. And obviously, commodity prices are a risk to that outlook. Okay, now we can go to the next pretty slide.
Okay.
And I don't have any terribly much to say about this, except that as economists, when we look to contributors to GDP growth, this happens to be contributions to GDP growth in the United States. So domestically, the slide represents U.S. growth. And obviously, we have consumer spending and net exports and business investment included in this graph. So there's a lot of detail here, and anyone who wants to go through it, happy to do that with you. But what you see in this time period, which is 21 until basically the present, right, quarterly, what you see in this time period is a lot of variation among the colors. And that's very different from time periods, other historical time periods. There's a lot more stability in consumer spending in other time periods than there are in this time period. And this is the recovery from COVID. Okay, so I just think it's interesting to think about how all of the price and policy, fiscal and monetary, and increases in commodity prices have affected the domestic economy so much that we would have such variability in the components to GDP growth that we do have now. Another reason why I say 10 years, it takes a while to find that new normal.
Next one?
Yes, please. Again, Marty and I were talking a little bit earlier, thinking about what this graph would look like in the 1980s, right? When I know that I took out a car loan in 1980 at 18% interest rate. I don't think many young people can appreciate that right now, right? So this is just a picture of the Fed funds rate and the kind of the monetary policy estimates that are expected here, right? So we had almost zero Fed funds rate for, a good part after the financial crisis of 2008. And then we had some stair-step increases in the Fed funds all the way back down again. And now you can see that there's even a divergence between the FOMC expectations and the market's expectations, right? The Fed's not gonna let that Fed funds rate drop until price stability is in its sight, and Powell and others have been completely clear about that, right? But we have seen signs that the monetary policy has started to work its way through the financial system. And we have, in the United States now, very tight credit conditions, and we've been talking about that with our cohorts here, and it absolutely affects real activity. In advanced economies, credit and investment demand has contracted, right? There's not as much money going around to fund projects, for example, reflecting a very tight supply of money as well as lower demand for credit because of the slowdown. So as many of the businesses begin to deleverage in response to higher interest rates and production overcapacity, right? Relative to trend growth now, we have overcapacity, we have overproduced. So higher interest rates have already put banks under increasing pressures in major economies, both through their higher cost of funding and indirectly as their credit quality on their books deteriorate. And we know that housing market has already been reacting with housing prices slowing domestically and sometimes even in some areas of the country reversing. And then we see bankruptcy increases, right? Over 20% increase in bankruptcies in the United States over the last year. So that's the impact of higher cost of borrowing, right, among other things. The last thing that as we talk about the higher interest rates passing through the balance sheet and affecting economic growth, I think one of the other things that's very important to remember is the impact that inflation expectations have on inflation. And so if inflation expectations remain high, prices will remain high. People will demand more money for their wage money, for example. Producers won't lower their prices with the expectation that inflation will be high in the near term. So consistent with theories, until expectations of inflation become more muted, inflation will continue to be an issue for our economy to deal with. Next. I said that the deficit and debt keeps me up at night. It keeps me up in part because the debt is really, really expensive to roll over right now, and interest costs are out of control. So really tough. If our current policies persist without any change, the CBO, or the Congressional Budget Office, projects that deficits and the debt as a percentage of GDP will rise as more of us become eligible for that Social Security check, and the Medicare and healthcare costs continue to increase faster than the rate of the economy, faster than 3%. Prices rise faster than 3%. We will have, and until interest rates become more normal, we will have increasing pressures on the debt. And so while recent increases in the debt seem manageable, right? It's always manageable. The debt can't grow faster than the economy indefinitely, or we go by the way of either Japan or Europe, right? Eventually, private borrowing will be crowded out by government debt. Again, another thing economists look at when we project economic growth. And we all know what crowding out means, right? For example, if it's used to finance the Treasury debt, if we buy Treasury bills, it means we don't put it into the small cap equity private fund that we're really jazzed about. So as borrowing costs increase, fewer resources are available for other investments, which will hamper and keep down and muted economic activity. Moreover, increases in federal borrowing puts upward pressure on interest rates. Each percentage point increase in the debt to GDP ratio boosts inflation-adjusted 10-year interest rates by at least 3 basis points. Higher interest rates raise the price of borrowing, deterring private investment. And according to some of the work that we're looking at, the net result of the trade-off is that every dollar the federal deficit increases, private investment will fall by 33%. So that elasticity is about 0.3.
Yeah.
So the question is, okay, we've got the developed markets and we've got the emerging markets, and the two kind of emerging markets that we're going to take a quick look at is China and India. Now, we know that China's growth in 2023 slowed considerably, and is expected in 2024 to be about 5%, if we're lucky, closer to 4%. And again, that scenario does not include a complete collapse of the real estate market in China. It assumes that we've bottomed out. The real estate market has bottomed out in China. So there's ample economic slack in China, and food and energy prices are declining in China. And we expect that they will continue to fall. On the right-hand bottom side of the graph in front of the chart in front of you is the kind of the equity wealth, right? And so the wealth effect in China is going to be huge. The idea that people have lost tremendous wealth not only through housing, but through their A shares or in their equity markets. So the wealth effect will continue. While China's GDP is less a function of consumer spending than the United States, it's still a big piece of it. So wealth effect is likely to have a continued negative impact on economic growth in 2024 for China. High frequency indicators suggest weakness in the property sectors in China, which is largest developer of a major beneficiary of government support. It is still under extreme liquidity stress. So these developers face severe funding constraints and preventing them from completing already pre-sold homes and buildings. And just like the United States, that's going to affect consumer confidence, right? And so prolonged consumer unhappiness, will you say, or lack of confidence will increase the economic duress. So yeah, consumer confidence remains subdued, industrial production and business investment also weak, exports are also weak, right? So we have a real, Chinese economy is in the doldrums. And likely that the economy is going to be held back by political tensions going forward, by population decline and regulatory uncertainty. But the bright thing about China, and anything that's down has got to come back up again, right? So while the economy has been very, very weak, it has the potential for some very strong catch-up. And anyone who's invested in emerging markets, and particularly China, knows that sometimes that ball bounces really fast. I don't see it happening anytime soon, but just watch for that property market to bottom out for sure. And it's not here, time is not here now. And then maybe we'll see some improvement in the equity valuations in that country. Okay.
Is China's problem a result of oversupply?
Overproduction, oversupply.
Of housing.
Of housing. Right. Exactly right. And tremendous stimulus.
Isn't there housing 2 to 1?
If it's that's low. I would say, it could even be greater than that. I don't know the ratio, but it seems like everyone's got a second house, if not a third. Who needs a third house? We're sick. So yeah, lots of trouble in China. Okay, next. But the bright side is India, right? There we go. India is set to become the world's 3rd largest economy. And we project that that'll happen in about 4 years. Its GDP growth is 5 trillion, will be 5 trillion at this baseline projection. And it will overtake both Germany and Japan as far as the size of the economy. And this growth that we expect out of India will be spurred by surging consumption and investment, both from domestic and foreign firms. What we do see in India, and we don't see in China anymore, is foreign direct investment going to India. FDI is one of the best predictors of not only economic growth, but capital market appreciation compared to other types of capital flows. And they have a huge population growth. So remember, we talked about the contributors to growth being population growth and productivity, and certainly that brisk population growth will spur the service industry in India. and we're expecting that GDP growth will average over 6% through 2008. We expect higher than 6% in the next year, but that to be somewhat muted after a nice little surge. The government increasingly attempts to pick winners in their private sector and their corporate sector, and that could be a risk, right? Because we don't always pick the winners right. But for the most part, we expect that India's economy will grow fairly well. Yeah, I mentioned that. So we're optimistic about India's near-term growth outlook as it reaps the benefits of the steps that it has taken so far, improving its fundamentals, more competitive exports, and branching into niche and complex manufacturing, incorporating AI, they're at the forefront there, and digitization resulting in improved tax collection, better fiscal policies, and economic growth. We believe that the momentum will be strong as the world recovers in late 2024, and that the global recovery will lift all boats and especially lift India. So while we're cognizant of all of the kind of downside risks to the global growth, with nearly 50% of the global population going to the polls next year, there's certainly some risks and uncertainty about how that will affect growth. But for India, we still remain extremely optimistic. That basically concludes my economic update for the group. Does anyone have any questions? Yes.
So what is your thoughts on onshoring to the U.S. manufacturing sector in the next 5 years?
We started this conversation last night, didn't we?
We did.
Yeah. I happen to be someone who believes in globalization or ties lifting all those. But when you study and think about closed economies, there are things, and Marty and I were talking about this morning, there are things you can control more easily. You can control your wages and your inflation and your exchange rate with relative to other countries if you're a closed economy. Once you're open, you have a lot less leverage to control your macroeconomics. Not exactly the answer to the question, except that if more, again, to the political realities, if in fact we have a return of President Donald Trump to the office, we can expect more of the island economy. I wanted to say machinations, but that's the island economy expectations to be reality, right?
But isn't that a trajectory where the cost to keep the trade routes protected is unsustainable for the U.S., which was the lead trade protector?
Costs are high, geopolitical uncertainties is going to cause that to be an economic reality, and yes, it's an expensive thing to protect those trade routes.
It was easy 20 years ago, but when the Houthis have ballistic missiles readily, it's very easy to disrupt trade routes, and it's too expensive for the U.S. to maintain, hence forcing islanding.
Well, and we're gonna see how that all works out for us.
So the United States has the largest economy in the world back in 1910. It had high tariffs. It was a mercantile country, and had no central bank. Taxes were 3%.
And small government.
Right, small government. Well, a little bit. I like to put a little light regulation, light bureaucracy.
And so without knowing how to handle that history lesson, I would say that it's also the case that in the 2000s, we had such low inflation in part because we were importing cheap goods, right? So it's a double-edged sword, right? Having open borders allows for specialization and efficiencies in goods, particularly goods to be shared. Look, we don't want to produce those, right? Mexico and China did, right? All kinds of goods for housing, furnishings, and child stuff. So An island economy is likely to cause our prices and elevated inflation for a long time. Getting back to 2% Fed funds rate is not going to be, in my opinion, a reality that we can expect to have happen if we close our borders and produce all of our own things. Now, having a 3% inflation rate is a really, while it's a goal of some, it's still too high because it erodes your purchasing power over time, right? Cumulatively. So you really want almost no inflation, but we want a little inflation, otherwise we would be in a deflationary mode and then production would go down, right? So the smallest amount of inflation, so people can expect a small amount of inflation, improves productivity. I am afraid that we won't get to a 2% Fed funds rate anytime soon. For the reasons we're talking about, we close our borders, we produce our own goods, we specialize in the things that we want to specialize in, but we have to import something. And I just feel like a 2% Fed funds rate is, unless we go into a serious recession or any kind of long-term downturn, which could easily happen. Nobody knows the future. We can only make projections the best that we can. But independent of the cost that it keeps trade routes open, because we could argue where we should be spending our money. But independent of that, closed economies will always have higher inflation rates relative to open economies.
So again, we talked about this before you spoke, which is that Europe, so I believe that open economies and over financialization leads to a lack of growth. So I think that what happened in Europe is that all the economies joined together, and in 2008, Europe was approaching the size of the U.S. economy, and post 2008, it's about 70% the size of the U.S. economy. So it's that tremendous, the growth that's just lost entirely, right? Because people over leverage whatever, right?
Well, economics is a really tough thing to get right. That's why we're called the dismal scientists, right? So, as you described the financial liberalization of Europe and then attributed their slow growth to that, I would submit that the slow growth might be more tethered to the lack of population growth in Europe, right? Components to growth. The only way you grow is.
But Europe has added countries. The EU has added countries since 2008.
So, yeah, but the population hasn't grown relative to the population of those combined countries.
They're already in trade, and they haven't grown. If anything, they're depopulating like China. But the thing, so we've done 2 fabs, semiconductor, in the U.S., and we were able to manufacture cheaper in the U.S. And we actually did a clothing company from raw material, cotton. We did cheaper in the U.S. But it wasn't because we moved it here or any kind of subsidy. We had to spend a lot of energy on innovation on the manufacturing side, right? So supercharge the tools of the worker. So there where we see the delta, right? For us to be competitive, when we lost 20 million workers, what do we do? Well, we innovate. What kind of tools does the existing manufacturing workforce need? Robotics, AI, on and on and on, right? But we're seeing a delta difference where that's becoming an option because the U.S. is one of the few countries that has all the 4 elements to maintain itself, versus China has 1. They have to import it.
I'm not as dour as Victor. I'm a believer in nearshoring, where Mexico, Canada.
Oh yeah.
There we go.
So you keep your cheap manufacturing
And you keep your
And
transportation costs down.
and access to the natural resources of Canada, right?
That's right.
So, but I mean, what we've learned is that a lot of the global financial institutions really have had negative effects on growth for other countries. I mean, the IMF and Latin America experience is devastating, right?
Yeah.
So there's a question from the audience on what are your thoughts on commodities? Because it seems like, commodities historically have been depressed because of financialization, right? But I think that, you have this growth in the global south and you're getting closer to true pricing. Any thoughts on that?
Well, commodities is a very broad asset class. And so if what you mean is energy, or what you mean minerals, and not that I can.
Gold and silver and oil.
There we go.
I'm just reading
Those
questions.
are 3 different ones as well, gold, silver, and oil.
I think, yeah. I mean, I'm gonna pass on that. Question from the audience.
So, you know, getting back to the discussion about Europe and how they haven't grown and, you know, growth. You know, funny enough, I was wondering, some of it seems like, you know, can you attribute some of it just to the lack of dynamic and, you know, economic environment? You know, we have a very laissez-faire, you know, regulatory environment, and the EU has had a lot of, you know, regulation, you know, added over time as they've integrated. Plus, we had the shale boom that happened after 2008. We had all this energy supply, cheaper energy, exporting energy. Europe, the opposite, you know, shale was kept off their shores and for all sorts of reasons. And they went another direction, and now it seems like that energy story coupled with a lot of regulation kind of, you know, it's a perfect storm.
Yes. No, I think your assessment, your scenario is spot on, right? Because Europe definitely was hit a lot harder as a result of the war in Ukraine, right?
Yeah.
Tremendous.
Yeah, it's compared to, you know, you know, they're importing like our LNG, like 60% of their imports.
And their prices are likely to remain very high because of that. Transportation costs or otherwise cheap supply, right?
Power.
But, I mean, so Europe economy shrunk 30% of their population hasn't shrunk 30%, right? The real issue is that all of Europe is globalization. European manufacturing has fled to Asia. I've got a lot of relatives who live in France, a lot of engineers, all their jobs are in Asia now. They work for the car companies, they work for whatever. Think about all the brands that have been bought by Asian companies, right? And so they're not producing anything except for services.
Well, that's true of Spain and France, for example, right? But, and Germany certainly has taken it on the chin.
Sure.
Which is
Because of energy.
Europe's manufacturing giants, right, and China as well. And both of those are in the doldrums in a big way, right? So that your friends in France who France otherwise would service industry would be doing manufacturing over somewhere else is not a surprise, right? Right. So
I'm just saying there's a stair step that, you know, all of a sudden all these productive companies were sold. Just like happened in the United States, where a lot of companies have been hollowed out, manufacturing been hollowed out and sent to China or wherever.
See what it looks like in the next 10 or 15 years.
we will.
But since we're in Texas, then you aren't in spot. What's the next 5-year outlook for Texas looks like?
Ooh, a Texas outlook.
Well, since you're here.
High growth. Moderate growth. You know, we do these things on capital market expectations, right? You're supposed to project what asset classes are going to do in the future, and you never see anyone face a negative return, right? And we have plenty of negative capital markets over the course of a year. Economists, you know, when we have nothing better to say, oh, it's going to be great. We're just going to grow, right? We've got a lot going for us here in Texas. We have population growth. We have productivity growth. I think, you know, we certainly have the capacity to grow our cities in a way that, you know, Europe can't. So, yeah, the sky's the limit for Texas.
That's pretty positive.
We'll end on a positive.
What about, so one question from the audience is, what about the cost of war to the USA? Is the cost of war the cost of trade? Is that keeping these trade lanes open, or?
The cost of war.
Right, so we're involved in Ukraine, we're involved in these many, you know, skirmishes in Asia where we've never won a war.
It's a really interesting question, one that I've thought about before with respect to printing dollars to send somewhere where the dollars don't affect our economy, right? The fact is that we have spent we have a lot of money that we've printed to support everything from pandemic to wars. And the fact that the cost of war is also an opportunity. We've got people manufacturing equipment for war, right? So there's a growth aspect to war, as well as the cost to war, in my opinion, is just the human cost to war. I don't really have anything to say about the impact the increase in production is having on the increase increase of production on behalf of places like Ukraine is having on our domestic economy is positive. But when you think about the money that it takes, that we're sending, it's not coming back here, so it's not impacting our M1, M2, or M3. Because it's not in our economy, so it's something to think about. But economists, again, don't really study that. They should. I remember in school, I thought about that. We talk about productivity, but we didn't talk about destruction. The opposite, right?
Sure. Any perspective on hot investment areas for the near future? Besides Texas real estate?
Texas real estate is hot. Oh, NVIDIA. I'm
That yesterday.
Yeah, notice that the Dory said the same thing.
Chips.
Really?
Chips and industrial growth, logistics, industrial transportation, energy.
Yeah. Relative strength among the sectors that we typically think of in an asset allocation setting. Utilities are looking really good right now. Real estate is looking really good right now. You've got energy looking really bad right now as far as near-term relative strength compared to the other sectors in the economy. But energy prices are up 25% over the last year or so, right? So we've certainly had a boom there. Perhaps that's why the relative strength bloom is off the energy sector. Yeah, give stock picks.
Fantastic.
All right, thank you guys.